In this video, we're going to talk about the second investing pattern, which is the turnaround. Hi, my name is Gary Mashurs. I'm the managing partner and chief investment officer of Silver Ring Value Partners. I also teach the value investing seminar at the FW Olin Graduate School of Business. So in the last video, we talked about investing patterns in general and what they are, which is that there is a systematic set of circumstances that reoccurs that causes a mispricing. And then you have to be able to take advantage of it at the moment. Now, you can't just say, well, Monday morning quarterbacking, saying, well, of course this was mispriced. It has to be visible as events are unfolding. The first one we talked about was the cyclical, and I encourage you to listen to that video first. But the second one I want to talk about, which is a little bit more advanced, is the turnaround. And the turnaround, so cyclical, you have temporary problems, but they're due to the economy or an industry level event, a cycle, and so forth. Supply imbalance, demand imbalance, and so forth. But the turnaround, you have company-specific issues. So the financial characteristic of a turnaround is that you have current profitability substantially below past profitability, and it's for non-cyclical reasons. It's a company problem. Maybe they lost market share, maybe they missed the product cycle, maybe there's some other issue, maybe they lost sales force members and therefore their sales fell. Who knows? There are many reasons why the problems can occur. And I think that people invest in turnarounds incorrectly. At least a lot of people do, and I used to. And so I want to share with you how I come to think about turnarounds and why. So I think the problem for investors with turnarounds is they focus on what may happen, which is that the company might turn itself around and restore its past profits. But they don't think of it as a low probability event. They think of it as the base case, a very likely scenario. And the reality is about 2/3 of turnarounds don't turn. They don't come anywhere near to their past profitability. So only about 1/3 of the turnarounds do achieve the old level of profits. What does that mean? That means that before you know or you have any information about which branch of the probability tree we are, is this the one that's turning and the one that's not, that prior profitability is not the base case, but it's kind of the upside scenario. And what people do is they buy this because it's cheap based on a fully turned around scenario. The problem is that's only going to happen about 1/3 of the time. The other times you can have a much lower level of profitability. So on a kind of an expected value basis, you're not getting a particularly good return. You just think you are because you're overly focused on that scenario where the business does turn itself around. And what I found is, and it's especially true with when a new management team takes over to turn around, but I think it's to some degree true when it's the existing management team. But let's say a new CEO comes in. I found that there's this 3-year pattern. The first year, the CEO spends figuring out what's wrong, talking to employees, customers, and so forth, suppliers, and then putting in place a plan for a solution. That's year number 1. And I think that's where a lot of rookies actually buy into the turnaround. And I was one of those rookies, so I know it takes one to know one, right? So that's bad. Don't do that. Unless, and I say don't do that, there's always the caveat. If the stock is some distressed price where there's, let's say, hard asset downside, such as there's cash in the balance sheet that protects you against loss, or it's so absurdly cheap that even if it doesn't turn, the business is still undervalued, that's different. But most of the time, that's not the case. Most of the time, you only make a good return if the business does turn at the prices that the market offers most of the time. And if you find one of the other ones, give me a call or send me a message. I want to know about those. But jokes aside, and actually I wasn't even joking, but seriously, you have the first year, the plan is set in place. Then the next year, the second year, you kind of start to execute against the plan. And the third year is assuming that the plan is working. In the second year, you accelerate and scale up the execution. So now, the other class of investors who's not coming in early, they're waiting for the profitability to turn. They're saying, look, we don't believe this. We're going to believe it when we see the earnings per share number go up. That's when we're going to buy it, right? That's also a mistake, because by the time that happens, the stock rates frequently to a much higher price, so the return is also not there. So what the optimal kind of sweet spot is when you have a situation where typically in year 2, you have early key performance indicators that are showing you that the turnaround plan is tracking, but the KPIs or the operating metrics, they're not yet reflected in the bottom line. I'll give you one example. There was a company many years ago where they lost a lot of their best producers in the sales force because the management changed incentives and the best producers left. New management came in. Their turnaround plan was very simple. They were going to hire back the old best producers. They're going to give them the incentives they wanted. No, so basically undo what the prior management team did. Now, there was some uncertainty. Would the people come back, the best producers? Would they be effective? Would their clients switch back, right? Maybe if they switched to another provider already, would the good salesperson coming back change their minds? Those were things that weren't known. So the plan was in place. They started bringing on a new, the old salespeople back. Well, what happened to the P&L? SG&A went up because salaries went up, but it takes some number of months or quarters for a salesperson to ramp up and generate revenue. So costs went up, but profits went down. Okay, but you don't have new information. Okay, so people are coming back, but are they going to be effective? Well, around the second year of the turnaround, you had information that the company was publicly disclosing that the first couple of cohorts of salespeople were actually exceeding their revenue ramp. Because month one, as you come in as a sales, you have a certain expectation for revenue. Month two, month three, month four, that's the ramp. And that caused management to actually accelerate their hiring, right, of the salespeople, because they proved to themselves that bringing those salespeople back would help bring the sales back. But what you saw in the P&L was just as the revenues from the first and second cohort of salespeople were coming in, that was more than offset by the costs of hiring the third, fourth, fifth, and so forth group of salespeople back. So you didn't see this impact in the P&L, but if you listen to the company in their public disclosures, you knew that their strategy was working. And the key insight about turnarounds is that once the turnaround starts to turn, it's very unlikely that it's going to reverse because the plan either makes sense and is working and is executable and is being executed, or it's not. So that's a much lower risk. So the probabilities have shifted now from whatever a third probability of a turnaround to being successful to well over 80%. And the price is usually a little bit higher, but not enough because too many people are focused on waiting for the bottom line to improve, not thinking about the key operating metrics because they're not studying the business deeply enough and understanding that those are leading indicators of future improvements in profitability. So if you can find a window where the plan is working, there are key performance metrics you can track that are showing that, but it's before the actual earnings turn, that's usually when I find turnarounds are the most mispriced. I hope that's been helpful to you. If it has, please hit like, subscribe to the channel, and I'll see you in the next video.